Good afternoon, everybody, and welcome to Live Market Analysis Macro Edition. That is where we look at overseas stock markets, foreign exchange, commodities, bonds, crypto, you name it, anything that's going on in the world of global macro. We can check it out in this session with a goal to helping you understand how it all fits together and, more importantly, how it impacts your portfolio. The agenda for today is, well, it's a Q&A session, really. I mean, I'm going to do a bit of a whip around the grounds. I'll tell you what I think are the most important macro factors going on at the moment, but always open to your questions and requests. I'll give you my best technical and fundamental reader where possible. If you're watching in the Zoom session, you'll have a Q&A or a chat window. You can enter your requests in there. If you're watching me on any of the streaming services, YouTube, Twitter, LinkedIn, Facebook, you'll also have a way to get in touch. Let us head over to the charts now. You're going to see appearing on screen the NASDAQ Composite Index. Very interesting chart at the moment. It's always interesting, but super interesting now. We're obviously, over the last couple of weeks, tracking its decline. We had noted the change in candles. You can see, really through this period for here, plenty of white candles, so many white candles. Even when it was down on a day, it was up. What does that mean? Let me just point out to you this candle here. Now, if we look at what happened on this, I just want to zoom in a little bit, because this is bull market price action, ladies and gentlemen. If you can get a feel for this, you will understand when the market is strong and when it's, there's underlying strength of the market, or when there's underlying weakness. You look at a day here. I mean, that's not a great day. Obviously, we know big black candle coming down, fighting a retreat through here. This one's a little bit more disturbing, full black. And then you get this candle where you actually open down on the day and then just power through to the high. I call it a fighting retreat. Look, I know it didn't do much there, but you kind of see more white candles. We got to the point where we started to see the black candles come in, and more importantly, unlike they had really been done up to that point, reinforced, and then we saw the lower point of supply come in. That's the lower peak, so there's a point of supply here. I won't draw them, there's a point of supply there, and we cracked through the point of demand. If you think about if you're in the Swiss Alps and you're looking up, you've got a mountain on the left of you, you've got a mountain on the right of you, you must therefore be in the valley. Okay, so between any of these two peaks, we're going to find a trough, we call them, and when you close beneath that trough, it tells you that supply is building. In fact, supply is building. In fact, demand isn't as strong as it was. We don't have a building demand anymore. We've got demand that's taking a bit of a backward step. So it was around here, I'm pretty sure, we said, look, we're going to actually take a short position on the NASDAQ, not because we think necessarily that we're at the start of a bear market, but simply we called it at the time to hedge out our broader NASDAQ position. We maintained it, I think, roughly around there and roughly around here. To be fair, you actually could have added to that short position if you wanted to. Even as soon as here, you're probably adding to it. We've had 3 out of 4 white candles. That's where we are right now. And look, one white candle does not a reversal make, but certainly it is the start of something. It generally can be the start of something. Reinforced here, I think, is pretty impressive. A little bit of a doubtful one here, and then I think pretty decisive yesterday. So this is an impressive bounce. V-shaped bounces are always the ones that have the best probability of success. I've said to you through this period here, the bull market is not over. On the contrary, we're just waiting for it to kick back in again. So is this the start of, or the restart of the bull market? Look, I don't know. I know that sounds like a bit of a cop-out, but I need to see a little bit more. So what I would do with the hedge position now is based upon 3 out of 4 white candles. They're very white, to be fair. This is a little point of supply here in itself. Okay, and then we've come back reinforcing with the point of demand. I think you take a third of your hedge position off the table, which means you're still retaining 2/3 of that hedge position. And I still think you're still relatively cautious overall on your holdings. I'm not just talking about obviously your US holdings, but this relates back to how we manage risk over here as well. We're going to have a bit of a problem here with the short-term downtrend. It is a downtrend zone, bona fide downtrend zone now, because the moving averages have crossed for a sufficient period of time to make it a downtrend. And on the way up, we know that short-term trend zone tends to support the price action we can see through here. So possibly it starts to resist it on the way back up. I'm still of the view that we take 1/3 of the hedge position off the table. How do we play it from here? Well, if we do see any sort of a pullback, you might even get a little bit of a candle that kind of looks like this. Maybe we get something like this today. And I know that's all purely hypothetical, but you get the supply starting to manifest itself just in and around this level. This is not a prediction. This is just a possibility. I want you to tune your eye in. And then let's say we get another bit of a pullback on the next candle as some of that supply starts to manifest itself again and people start to get a bit panicky. And that's what we want to see. We actually want to see some panic here. We want to see the market start to get really nervous again. We want people to remember, have people forgot about this downtrend? No, it's still fresh in their minds. We want them to remember it. We want them to fear it, to fret about it. And we want to see some supply come back. And it's after that supply, that's when the real indication will come for us. So if we can see after that, the next pushback up, nice big white candle. What's going on there? Let me just make that appear. Can you appear for me? What did I do wrong there? Not sure what I did wrong. Let's go. No, that's not doing it for me. Let's do that. That's kind of getting to where I need it to go. Let's go that, and boom, there you go. So this is the type of price action I need to see to reduce that hedge position further. And as I'm reducing that hedge position, my shareholdings, my portfolio is getting better as well. Okay. The whole idea is that they're balancing each other out to minimize our risk, to reduce our losses in these sorts of periods. That's the point of a hedge. The point of the hedge is not to make money. It's simply to neutralize our P&L. Okay. Until we get to the point where the index is doing well enough, where our portfolio is doing well enough, it doesn't need that crutch. It doesn't need that support. It doesn't need that insurance anymore. So this is where I'd go, say, the next third off the hedge position, and then let's not go any further than that. I think we've gone far enough. Now, if we don't get this, okay, so we'll call this scenario 1. Okay, let's look at the other potential scenario. Is this black candle here isn't something as benign as the one I've drawn, but potentially it starts to do something like this. And then you're very much holding on to your hedge positions. And if this progresses to the point where we're starting to really pressure and break through, this is the key point of demand. I cannot stress how important this point of demand is now. If we start to close beneath there, then it is now really challenging our notions of whether we're in a bull market or not. Okay, so we'll call that scenario 2. Neither is a prediction. I don't predict. I'm not a prognosticating technical analyst. I am a reactionary technical analyst. I react to what I see. I'm just giving you scenarios so that when you see them, you'll know how to react. That is an important chart, I think, because it is the most sensitive group of assets to what's going on here, which is the next most important chart I'm going to show you today. In fact, it's probably more important than that one. I have to scroll down to my yields. You know where I'm going next. If you're a regular listener to these macro sessions, you know that it's all about yields. What do yields represent? Yields represent the price. I'm going to start with the twos. Obviously been pressing high. So this is shorter term yields here. This is the one that is pegged much more closely to the Federal Reserve's cash rate. A cash rate is instantaneous. This is obviously over 2 years, so it won't be the same. It's a little bit lower, but it certainly it reacts more up to a certain point. Okay, so we've seen a general rise in those short-term yields. I just want to go through the spectrum here. 10s have risen substantially more than that. 30s more again. So we have seen these long-term yields rising and really just crushing and sucking the life out of that NASDAQ. It's no surprise that the NASDAQ has had troubles since, and just to overlay these charts, overlay the NASDAQ and this chart equal and opposite in the other direction. And this, ladies and gentlemen, the NASDAQ, NVIDIA was up last night. That's why the NASDAQ rallied. That is not why the NASDAQ rallied. The NASDAQ rallied last night because that black candle appeared to create the corresponding white candle on the NASDAQ. And I just gave you all these scenarios, much of that doesn't matter. What's going to matter is what this thing does next. And if this thing continues to push down, that's going to equate to that scenario 1 on the NASDAQ. If this thing somehow manages to turn around, let's draw it in a different color here, let's draw it in red. If it starts to do this, right, then the NASDAQ is going to go into scenario 2 big time. If this cracks through 450, we're in trouble. Why? What we're looking at here is the price of money. The price of money over 30 years pushing up towards 4.5%. Risk-free. Uncle Sam, risk-free money returning 4.5%. That sounds pretty good to me when the S&P 500 is yielding about 1.5%. I shudder to think the yield on the NASDAQ is, because it's probably less. And it's probably less because the NASDAQ tends to be earlier stage companies. They are retaining their earnings to grow their earnings further. They typically have higher debt levels because they're early stage companies. They're not big, fat, boring companies like General Electric. Okay, that exists in the S&P 500, for example. So they are the most sensitive to these rising rates. Last night's pullback, that big black candle, ladies and gentlemen, I cannot stress to you the importance of it. Let's look at history. What does history tell us? Well, certainly big black candles turn trends. There's no difference here between just because it's still a chart. It's still a chart with trends. It's still a chart with candles. It's still a chart with price action. Because what we're looking at here underlying is not a yield. The yield is I was going to say yield's irrelevant. It's not irrelevant, but the yield is a function of the price of these bonds. So the price of these bonds is doing the opposite to what we're seeing with yields. There's an inverse relationship between the bond price and the yield. Okay, so if we turned every black candle white, every white candle black, and we flip this chart upside down, we would get the price of bonds. So we can see that the bond prices are selling off. Bond holders, investors are selling their bonds and they're not wanting to buy new bonds. And the main reason for that is because Uncle Sam, let's hope he keeps paying his bills, because Uncle Sam is up to pussy's bow in debt, and that debt is only getting bigger and bigger. And why is that debt getting bigger? Because Uncle Sam has to pay more interest on those loans. All that debt wasn't such a problem when rates were not that long ago, rates were all the way back down here for your 30 years. And if you go to tens, down to below 1%, and on their short-term borrowings, almost 0%. So Jerome Powell, thank you very much. Not only did you cause a big bear market when you started to increase those rates, you've just thrown a big bucket of gas, of oil onto a fire, and that can create so many problems around the world, because as these bond prices fall, and you can see they are falling rapidly, you have a bunch of holders of those bonds who unfortunately are losing money hand over fist. Yes, if they invest now, potentially they're getting a higher yield, but unfortunately they invested before. They invested when yields were very low. They needed safety to back their balance sheets, and this is causing the banking crisis through here, coming home to roost. And we haven't even seen what's happened yet with exposure to some of those mortgage-backed securities that are probably in big trouble, and some of those exposure to real estate assets as well. But I'm painting a very, very poor picture. I don't know what's going to happen next. Do you? If you know what's going to happen next, please let me know, of course. But we're just monitoring this situation here. We don't want to see this get really bad, because if this gets really bad, we're close to breaking something again. So I think Jerome Powell he's sown all the seeds for unbelievably horrible breakages in the US economy and in the global economy, obviously, because we've got some other stuff going on simultaneously, which is not helping. And of course, I'm referring to this, it's the Shanghai Composite, the fact that the Chinese economy is, for all intents and purposes, much like its stock market, about to fall off a cliff. That's the shares that everybody can buy. These are the shares only Chinese mainland investors can buy, but also institutions with the right credentials. And that's looking pretty poorly. And of course, it's all about real estate, which continues to fall. And then the Hang Seng Mainland Property Index is printing new sort of 14-month lows. So we are doing a bit of a whip around. And if we go back to the first chart we looked at, maybe it helps you understand whether we're going to get a scenario 1 and scenario 2. And I honestly don't know. Because nothing is better for a bull market than the fear of missing out. And nothing stokes those animal spirits of missing out more than prices going up. So if prices can go up, it'll make prices go up. And the big hope, of course, is all of that debt will go away, and all of those debt issues will go away if the US economy is strong. That's the big hope. But how does it stay strong when Jerome Powell seems hell-bent on reinforcing his credentials as an inflation fighter, to go down in history as an inflation fighter? What does that mean? I just want to just show you the real yields because it's one we have been watching very closely. They took a downturn last night, but not after they topped 2%. So, of course, this is the yield net of inflation. I'll show you what inflation looks like over here. I'm going to head to a slightly different chart. I know I'm talking a lot, but then I'll stop talking and we'll get to your stuff. So I did get asked a question via the Twitter during the week for people that want to play along at home, and please do. And I think it's so wonderful that you're starting to put some importance on this macro because, maybe 6 months ago, maybe before you met me, you're just obliviously holding your Aussie banking shares and punting your lithium shares on the side. But this stuff matters. So the question was, Carl, I can't get the real yields. How do I do that? It's not on TradingView. It's not on TradingView as far as I know. But if it is on TradingView, hey, let me know. Jump on the message and let me know what the tip. So it's a Treasury, that's the Treasury inflected inflation protected yield, okay? The 10-year tips, and they've got 5-year tips as well. So that's our proxy for the real yields. Now, how do you get it in TradingView? Well, what we do have on TradingView is this thing here, which is the 10-year inflation expectations. So you can see that currently it's about 2.34, 2.35%, okay? So this is what over 10 years, the market is saying inflation is going to be. Now, the good news is the Fed's target is 2%. So you can see how we went above that for a long period of time. And then right here, look at this. And this is why Jerome Powell kind of had to do what he had to do, because that's April 2022. In November 2022, he started high. Well, he said he shuffled his papers at his acceptance speech, didn't he? And he said that, let me turn me back on so you can see me. He shuffled his papers at his acceptance speech of his second term. And he said, we didn't say it, but he said, I'm going to start being very tough on inflation because that's what he was dealing with. And you can see how, as he's been increasing rates, those inflation expectations are coming down. And this is a good thing. This is not a bad thing. This is a good thing. These are coming down. We don't want to see them sort of pop up more recently. Okay. But how do you get your tips yield? Well, you've got your 10-year yield, which is 4.2%. That's one you can get. It's just US 10Y. And then you've got your 10-year expectation. So real yield is simply yield minus inflation. And that's this 4.2 minus 2.35 gets you to the tips yield I showed you before, okay? You can't plot it specifically, but that helps you understand how to do it if you want to play along at home. Okay, let us leave my rantings there. Hopefully that gave you a good overview of the stuff that's important right now to you or into your portfolio. Let's go to your requests. I've got one coming in from Huzul, who is saying, can we go through iron ore chart, please, and my thoughts on iron ore? Iron ore is a little bit confusing at the moment, Ursula, because it has had a massive run up. I showed you those charts of the Chinese stock markets, and obviously, China is the biggest consumer of iron ore globally, and much of that iron ore is used to produce steel, which then makes anything from fridges and freezers that get sent back to us over here in Australia, to motor vehicles, to big steel girders that go into their property sector. I think the property sector, don't quote me here, and I'm just going to tell you I'm making this up, but I think it's about 50% of steel demand in China is the property sector. Somebody will Google it and find me the stat, but I think order of magnitude, let's say that. That's where it's going. So if the property sector is very weak, it's not good for iron ore. That's the upshot. And we would expect the iron ore price to be going down. That's not the case. Iron ore price is rocketing. It's gone from 720 to 820. Let me see what it's doing today. That doesn't have today's print on it. It is up 0.5% today. It's trading around 822. Change screen. Thank you. Where did I lose you? I lost you a little while ago, but we didn't go far. I was babbling. We were getting to iron ore, okay, which has had a little bit of a rally there. Thanks, Barry. Why is it going up? I'm not so sure. A couple of weeks ago when it started going up, sort of go back to where it started going up, we had the announcement of some of the curbs on steel production in China. So for the last 12, 18 months or so, the Chinese government has been imposing these curbs to their view. Their narrative is it's to help with their pollution problem, potentially also to limit excesses in the industry, which is notorious for its excesses. And those curbs were not as drastic as originally feared. And I think that started the rally. Since then, we've also seen some of the steel spreads start to improve. So some of the profit margins for Chinese steel producers, but it is an extremely opaque industry, the Chinese steel industry, and it is manipulated, obviously, by the regime. I can't explain it to you. It's gone up. Let's just focus on the chart, supply versus demand. It was looking pretty awful. Now it's looking okay. Does it look like it can go higher? Yeah, look, if it pulls back and holds, let's say if it does something like this, for whatever reason, and we'll never know the bloody reason, let's face it, then it's starting to look quite good. Actually, it could probably push back into 880. I can say seasonally, this time of the year is not a good time of the year for iron ore prices. August, September, October, the weakest period of the year, and then November, December starts to be the better. It's all based around their seasonal patterns and when they stock and destock based upon the weather, largely. So is it in it? Some people have asked, oh, look, does this mean the stimulus is coming? Honestly, I don't know. I wouldn't have a clue. But there you go. We can look at the chart. We can try and understand what's going on in terms of supply and demand. Michael asking about lithium, a lithium update. Well, I've gone to updating you daily on the lithium charts. I figure these charts aren't that easy to get. I mean, you can get the last month or so of data from a couple of outlets, but they don't give you the big chart. So I've managed to scrape and scrounge and get data going back far enough to give you a reasonable picture of what's going on. And then I keep this up to date daily manually as well from various data service providers. So I think it's pretty hard to get, and therefore I think it's pretty neat that you can kind of get it from a tweet from me each day. So I'll keep doing those on a daily basis, and I'll give you the daily changes. This is actually happening right now. I mean, this is real. This is like every single day, just about. Now, there's a few days where it doesn't go down. We're talking about lithium hydroxide here, which is a refined product. You don't pull this out of the ground. You get it from refining lithium carbonate or your spodumene, and we'll look at both of those charts in a while. Then we can see substantial decline through here, and literally every day it keeps going down. The short-term trend is down, the long-term trend is down. If this was a chart, you wouldn't be buying it. Where could it find some demand? And we tend to find demand at historical areas of supply and historical areas of support. And 166 is the most logical target for me. I think 200 here is going to be a bit of an issue as well, because it's a bit of a round number and we may see somewhat of a bounce to there. But otherwise, I mean, the angle of attack looks like it could easily get down there. What does this mean for your lithium companies? I don't think it means a great deal in the, I was going to say short-term, long-term. I don't know. Lithium stocks tend to not fuss too much about these things. But I think in the long term, if it does keep going down, eventually there's going to be this overall drag on the sector. I think a lot of our, just the stage of where our companies are at, they're still finding new discoveries. They're still increasing their resources. They're going into production, increasing production. And at the end of the day, a company's value is going to be determined by its profit and loss or expectations thereof, its earnings. And some of those earnings factors, as we're in that ramp up phase, are outweighing some of the ebb and flow of the daily spot price moves. Okay, and a lot of these companies are going to work on longer term contracts as well with customers instead of these spot price moves. So don't automatically go, that's heading down, therefore lithium prices have to go down, but it doesn't help, is I think the message you need to understand. Lithium carbonate prices, all chem, your lithium brines, this is what your lithium carbonate's coming from, starting to level off actually, and that's the start of potentially stopping going down, is the price goes sideways. V-shaped recoveries are always the best. You can see the move there from 165.5 up to 314. If we do get that move here, I know lithium hydroxide looks pretty awful, but if this starts to turn up for whatever reason, I wouldn't have a bloody clue. Don't consider me to be an expert on the Chinese lithium market. I'm not. I read charts. That's what I do. But what I can say is if this starts to V-shape back up again, say through 280, 300, then it's going to look amazing for this broad double bottom. And it's going to tell you that we have found a floor in lithium minerals prices, and then watch lithium companies probably get two rockets under them after that. I'm not a lithium bear at all. I don't hate lithium. I don't hate lithium companies. If that's your view of me, you have got me all wrong. I just follow trends. I just follow charts. I've got no opinion on the underlying fundamentals of these things. But hey, the underlying fundamentals are probably having an impact. When you look at a chart like this, it's pretty convincing. That's your spodumene concentrate, the key contract there for Pilbara Minerals and the like. Draw any conclusions you wish to draw after that. I think an obvious place to go after lithium is to go hashtag uranium. So let's have a look at the uranium price. That's the one there. So that is continuing to do the right thing for the uranium bulls. That's a week old because that's coming from Norgate data. I do have another one in here. I thought I had it. Maybe it's not there in that list. Oh, it's down here. There it is. That's the one that's up to date. So you can see a very nice trend in uranium prices, and 60, as I've said many times, is that key level that delineates many mothballed projects, much mothballed production, even at the big producers at the moment, making it economic again. So that will help your lithium, slip of the tongue, your uranium companies, if we can get above there. And I can't see anything in the trends here to suggest that we can't do that. So whereas, I can't see anything in the lithium minerals trends to suggest they're going to turn around anytime soon, I can't see anything here to tell me that anything bad's going to happen anytime soon. Because I have to believe that the market is fully informed and that you've got some very clever actors in that market buying and selling based upon the very, very good information they have that I don't have. And that's why I don't seek out that information, because I'll never have as good information as them. It is why I look at the charts, which is where they act. Let us go to a few more of your requests. And looks like we're going to go to foreign exchange. If there are any other requests for commodities, now's the time to ask. Maybe let's have a look at some of the base metals while we're here, seeing as we're looking at some metals. And then I'm going to yours, Craig, next. Aluminium got a little bit of a bounce. When I say a little bit of a bounce, as little as you can get, isn't it? Just pushing back up to that short-term downtrend zone. The long-term trend is still clearly skewed to the downside. And we're looking at London Metals Exchange here. LME up the top here stands for London Metals Exchange. Copper getting a nice little bounce there in line with the iron ore price. Is it hopes of Chinese stimulus? I don't know. Is it short covering? I don't know. I can't tell you. I wouldn't have a bloody clue. This is let's go here and here. This is a little bit more technical analysis on the high grade chart, which trades on the COMEX exchange in the US. Still largely range bound, isn't it? Copper bulls. I know there are some really emphatic true believers out there in the copper story. And if you're right, I think the chart would be doing a bit more than that. I think we'd be trading above 403, which I think is the key level. Beneath that, hard to get too excited. Certainly if we start trading beneath 356, then we are in a global recession. Like something really bad has happened if we're trading beneath 356. Heading back to, we can stay here. Why don't we stay here? No, let's go back here. And I know I'm jumping around, but that's, I'm going to go here. There we go. When I looked at iron ore, look at nickel, a little bit of a bounce. This we are seeing base metals rallying actually over the last week or so. Lead, that is a very impressive bounce. Short-term trend swinging back up, holding above the long-term trend zone. Tin, there's also a bounce there, going to be impeded, I think, by those trend ribbons. And zinc is a very, very modest bounce also. So base metal starting to pop up. Let's do gold while we're here. I know gold prices got a big bounce last night. You all know why now. You can't not know why. Gold doesn't have a yield. It suffers when yields are rising. I actually think gold's done really well, because I would have thought gold, honestly, would be trading at $1,600 an ounce, given what's happened on the bond market, in the bond market, and those yields. So actually it's done really well. And I think it's doing well. I know you're saying, hey, Carl, it hasn't done well, it's gone down. I think it should have gone down more. I think it hasn't gone down more because of this flight to safety, this idea that there are some things that could really go wrong in the global economy. Things are starting, if they're not breaking yet, they're certainly creaking, and therefore we want to own some gold. And then when you get that final piece of the puzzle, which is yield starting to back off, that allows gold to put in that little white candle. Would I buy it here? No, I can't be a buy here. Why? Because I have rules. The short-term trend is still very much set to the downside. The long-term trend, well, we actually broke through it. That's not a good look. And we're coming back up to test into it. And the problem now is if we actually fail here, it's about as bearish as you can get. So if we fail at the long-term trend zone, if that long-term trend zone goes from being such a reliable indicator of where we're going to see these long-term bounces to actually impeding upward price action, then I think we are going to go to 1680. I can't even imagine the macroeconomic circumstances which would make that occur. Is the world broken or is it fixed? I don't even know anymore. There's silver getting an even bigger bounce. Tends to be a higher beta play on those interest rates, and obviously yields coming off means silver heading back up. It's still largely range bound. It's not something I necessarily would be taking a punt on just yet. I want to see it build up substantially more demand, a bunch more white candles, a bunch more price action towards the top of that range to tell me that we're not just going to hit it and come back straight back down again. Okay, we'll finish with energy, which is going to be, where should we go? Coal. Well, we've got a Brent crude. We've seen, obviously, maybe crude giving us a more accurate picture of what's going on under the surface of this China situation, because the resurgence of this doubt in the Chinese economy sort of picked up around here, didn't it? We haven't really seen it perform all that well since then. In fact, lower points of supply are quite clear on the chart here. And nearly, but not quite cracking through that point of demand. We just managed to avoid that. Potentially, we've got some dynamic support coming through from the trend ribbons, and I will not get anything close to bearish on this until we're really sort of trading down here and it's starting to reject those levels. So neutral at best on this one. I must admit it was looking fantastic right here, and that's just how the cookie crumbles sometimes. West Texas crude oil is going to look very similar. Don't need to do any more on that. Natural gas flamed out, no pun intended. Turned out to be nothing. Got a bit more of a move in Europe than in the US. Coking coal continues to rally on the back of those stronger iron ore prices. But that chart actually looks quite decent here. I know there's a long-term downtrend still in place, but that short-term trend is very, very strong. And then we've got thermal coal, which is not there for some reason, but should be. I've lost my thermal coal. That's very weird. Where's it gone from that list? That's all right. I've got other lists, and it's disappeared. I can't even tell you where it's gone. Newcastle. Let's try that. No, it's disappeared. I'm sorry. Thermal coal's disappeared. I can give it to you in another place. So let us head over here and go to here. And I'm sure you're already playing along at home on this one. Actually, a little bit of a pullback there. But otherwise, trying to turn the corner. Okay, let's head over to G'day Carl. Max is saying, I was wondering about large daily discrepancies between US natural gas and the European gas. It just depends on how well or how poorly stocked they are in the US, which itself is a major natural gas producer and obviously a crude producer as well. So they are less dependent on what's happening here on the Northwest Shelf than Europe is, and that's all it comes down to. So basically, what you can trade and what we offer a CFD on is the US one, not the European one for whatever reason, and that's pretty much consistent across most of your brokers. And unfortunately, the only way you could trade it was through that US natural gas, which then didn't go up because there's just not the urgency or the supply constraints or potential supply shock that there is in Europe. And that's why that happened, Max. That's what happened there. All right, let's head over to the Forex. I've got the US dollar versus the Swiss franc coming through from Craig. Thank you, Craig. USDCHF. And asking about a short trade here. Yeah, look, I can't see why not. Price action is still, I was going to say the price action is still sort of trending higher, but we're seeing the smallest inklings of a little bit of a change there. I think you just find a little point of demand to target. I know there's one here, and it's just about how confident you want to be. I think if you wait till down here, 86.90, well, 87-ish, I think maybe you're giving up a bit too much. But maybe, let's say, if it closes 87.40-ish, then adding some risk at that stage, just so you've got a nice black candle. A close beneath would be good, but I can't see why not. This is starting to roll. If you wait for it, it will be beneath the short-term trend zone. Long-term trend is very much set to the downside. So yeah, I can't see why not. Is it one I'm going to rush out to do? I don't know, is this the best FX trade I can find today? I'm not so sure, but happy to look at some of the other ones you're interested in. Let us, I've done uranium, done all of those, and I've done all of those. So you're all very quiet today, got plenty of people here. It's not from a lack of people attending, maybe a bit shell-shocked or a bit confused as to what's going on, fair enough. Let us look at some of these trades we have been looking at in the past. So Swiss yen, and this is a trade that some of you may have opened. It's one we've talked about a number of times. Do we need to manage our risk on this? Not right now. This is an important candle here. So you blend those two together, you get a very strong candle. I think that's your key point of demand now. So close beneath 164.29 would be where you would take 1/3 of this position off the table. So 164.29 or lower for a manage the risk. On that one, let's look at Daniel's AUDUSD, which we had been talking shorts on. Got a bit of a bounce there from the pullback in those US yields. So it is beholden to that situation. So again, if you see US yields pull back, you're going to see this continue to rally. And if they have another resurgence, you'll see it go down again. I think this candle here is enough to maybe take 1/3 off the table just as a precautionary move. But even then, that's probably being a little bit jittery. Stops, I think, need to be certainly above this high here. So probably in and around that range, say 65.43. You go a little bit, maybe 65. Get above the short-term trend zone. Maybe 65.67. And above for a stop. I don't think you want to get much closer than that. If this big white candle is reinforced, then you would take more drastic steps to extricate yourself from the short trade. But it was looking quite good until we see today a combination of the rates, and there was some data as well. I can't recall what happened on that day. Maybe you'll recall. Iron ore prices rallying also helps this one. But they're all fundamentals. There's a bit of demand in the system, and that could trigger a bit more short covering, which could take it just that little bit higher and put pressure on that short trade. Plenty going on in the macro to change things up on a daily basis. Let's want to head over here now, and we're going to head to the NASDAQ hedge. Well, actually, there you go. That NASDAQ hedge has gone from a $250 profit, I didn't know, to a $7 loss. So, and that's okay, because we would have seen a substantial increase in the rest of our position. So let us sell, just in line with what I said, the 1 unit, because we did take on 0.3. Okay, so just to see how that works. And we should see that update in a little while. The little bell chime comes through. You can't hear it. Okay. I did that on purpose. What did I do, everybody? Our NASDAQ short position. Which we're looking to close out 1/3 of. I just sold. It went from 0.3 to 0.4. I totally meant that to happen. What a great case study in just the mentality around your trades. If you just get caught up in this, I've got to buy and then I've got to sell, you're in big trouble. When you're shorting, you sold first. It means you need to buy second. Okay, so now, and I wonder how many people have actually done this. I'm sure you've done it before, where you've gone, oh no, I did the opposite. There you go. That's how it works. So we're going to now buy 2 back. And we're going to see that we're at the 0.2 that we should be at now. Okay. Swiss yen we talked about. I don't think we need to do anything with it. What about some of these other trades? Aussie Swiss. Let's have a look at that one. Let me head over here and over here. So Aussie Swiss, which is not on that list, but it's on my other list here, coming up in a second. There you go, starting to rally a little bit as well. Let's go to our candles. No, I don't think we need to do anything on that. Just I know that candle's frustrating and annoying, but I don't think we need to do anything yet. Just check the price action through here. So we have this. No, it's all one move. We don't. It's not like we have high peaks and high troughs yet. That's just all one move. So I would say we're still carrying the full risk position on that, but a little bit frustrated by how that one's going. And let's go back and check some of these other ones. So we're going to go to the, what else have we added? Sterling yen. I know that's one we've added recently. Let's check up on that one. I'm going to go here and here, GBP, JPY. That would, I think, give us cause to take some off the table here because we have closed beneath this point of demand. So 1/3 off the table there. And the way you would enact that, because it is a long trade, we would then be looking to buy a sell out of that. So I don't think I have it here. Let's go GBP, JPY. And we're going to go here, and I'm pretty sure, so we could track it. I did the 3 units, and then that one would come out, just managing the risk on that one. And what else have we got going in here? The NASDAQ we did, the New Zealand dollar versus US dollar. How does that one look at the moment? Let's go here, NZD, USD. I don't think there's any reason to do anything on that just yet. Okay, Bitcoin from Haraju. Let's have a look at that one. So Bitcoin is in the same boat as any other risky asset, and it's one of probably considered to be one of the higher risk assets out there. Even Bitcoin, well, Bitcoin maxis probably wouldn't agree, but in the world of finance it is. So we have seen, as those yields have pulled back 2 sessions in a row, we've seen a bit of a rally in Bitcoin. And that's all that is about. I know this, I don't know, this is saying, some people are saying a bunch of stops got run, a bunch of liquidations. It could have been the news that Elon Musk had previously, prior to that, liquidated some of SpaceX's holdings. It wasn't SpaceX selling in that candle. That's just crazy and silly and naive to think that. SpaceX probably was selling through here. They would have waited till it went up, and they would have been selling into this rally, which is why this rally never got going. And then they announce it in their quarterlies, and then the market responds to that negatively. There certainly looks like there's plenty of demand down here. If this was a stock, we'd say there's plenty of demand in this region, but you would not be an owner of it right now because it has not done the right things to warrant owning it up to this stage. What could make it warrant owning it? Well, higher peaks and higher troughs, some big nice white candles, and you could take some speculative trades probably on a move through, say, 27.5-ish. But without those candles, it's probably not worth speculating on it. Max saying, on the Aussie dollar, can we look at your projections for the next RBA meeting if I have it at hand? Yeah, we can. That's not hard to do. That's I'll show you where I get it from, so you can follow along at home. And this is where most of the people in the industry get it from, and I'm in the way of that. But there we go. So this is simply what the market is saying about the next meeting. So as of yesterday's close, we were 88% based upon the futures market pricing, the probabilities and what they mean about it. So some of those futures are going to have a rate that's higher going forward. Then, so it's all about this curve. It's based upon this implied yield curve, okay, and where that's at, okay. So we're saying that most market participants, therefore, implied by that curve, are saying that we're not going to get a hike at the next meeting. We'll be on hold, and 12% are saying we will get. Oh, look at that. That's a decrease. Well, that's just not going to happen. I didn't pick that up. I've just assumed that that's been an increase for the last 12 months. That phrase there has been increased. I didn't even know that the ASX changed that to decrease. And they will have to change it, not because they think otherwise, but you can see here that we can see that we're actually, the blue bars are beneath the dotted line, which is the current rate. Okay, and when the blue bars are above, then the market is thinking increase. The blue bars are actually below, so I hadn't actually seen that change. So probably only very recently that's changed. There's no way we're getting a rate cut at the next meeting. That should be zero. I can't believe the market has got it that wrong. I'd be saying there's a 12% chance of an increase at the next meeting. I'd say there's actually more than that. So my gut would say we're 75-25. 75% hold, 25% hike. There is a very real, tangible possibility that we get a hike at the next meeting. And that would further help the Australian dollar to appreciate against the US dollar. US dollar versus the Chinese yuan. Okay, not one I think you can trade. I don't think we have it on here. Okay, RMB. No, I'm going to go CNY. I just know we don't trade it. I'm not sure what platform you can trade it on, to be honest, but we can look at it. I'm guessing TradingView will probably have it. So let's go USD CNY, RMB. It's just not one we trade, so I've never bothered to actually chart it, to be honest. Mighty Motes. If you know what the code is, then let me know. CNY would be the, well, if I go CNH, there's a few possibilities here. So, yeah, I can't. I'm looking in stocks. If I go all, that might give me a chance. There you go. Wasn't that hard? Okay. I just don't think you can trade it with any provider. There you go. It's trending higher for obvious reasons. We've got a weakening US economy. We've got Chinese rates getting cut while US rates are very much tracking towards the upside. So it makes perfect sense that the chart should look like that. But how do you trade it? That's the problem. Okay, well, I've done my whip around the grounds. I've done everybody's, actually wheat has come through here from Craig. Let's have a look at that one. Going to go back to our futures, agricultural commodities, so you can actually trade wheat with us. So if we do see a trade here, it's one we can actually put on and just track it, see how it goes. Long or short, Craig? I don't think it's a long. I don't think it's a short either necessarily. I think there's a little higher peak, higher trough here. I think it's just very range bound, isn't it? I mean, there's a bit of a bottom of the range there. I'm not one to try and take speculative longs based upon that. It's just not my trading system. Some people will, and good luck to them. Some people will short it at the top of the range. Good luck to them. But that's just not my model. But I can see, there's the possibility that we get a little bit of a pop, a little bit of a rally, maybe being impeded then by the short-term downtrend zone and probably rolling back over again. That's what I would say. But it's certainly not one I would short because this candle is far too strong. That's a higher peak. That's a higher trough. And we're on the verge of making higher peaks. So I can't short it and I can't go long either. That's just my model. Tea. That's a good one from Max. I don't know of any traded tea contract. We can look at coffee. Okay. But unless you're offering to make me one, Max, which I would love one because I've been talking for 2 hours. It's just on the call and now I'm doing this. But I don't think that's what your offer is there. Coffee futures have rolled over. That's Arabica coffee there. There's two major types. And then you've got the Robusta coffee, which still looks okay. They're heading in different directions, different supply-demand dynamics. EURSEK, Swedish krona. How about that? I definitely don't have it on here. It's certainly not one of the majors. EURSEK. I could only imagine the Swedish krona actually heading up, isn't it? So euro, the outlook for European interest rates, much better than the outlook for Swedish interest rates. I think it looks pretty good. Could you buy it? I think you could buy it on the next decent candle, next lower shadow. Not right now. I think this candle here is very bearish, and this candle is reinforcing that bearishness. So you're in pullback phase here, and probably looking to make another run. But then, yeah, on the next close through say 1193 or better, yeah, I could buy this. I could add some if I was that way inclined. But honestly, I'm not. I wonder what the spread will be on that one, William. It'd be massive, the EURSEK. Do we even offer it? Let's have a look. EURSEK. Oh, we do offer it. Let's have a look. The spread, 27 pips there, quite big. And that's just a function of it not being traded very much. USDCNH on ThinkMarkets. Oh, we do have it. Bloody hell. Oh, I can't believe it. There I was saying that it's not traded. It is traded, and we offer it. How good's that? I had no idea, honestly. It's just not something that's commonly traded. And the reason for it is that the movements are actually very, very small. So that looks like it's gone up a lot, but it's actually moved from 6.7 to 7.3, which actually is, to be fair, is a massive move for the Chinese currency. But typically, it's quite a managed move. It's actually managed by the Chinese government. So there you go. I didn't know that. You can trade it with us. How good's that? All right, well, we'll keep an eye on this one. We'll start to track this one going forward. What's the spread on this? Only 8 pips. That's actually better than I thought. How about that? Well done. Mighty Mo's test. Egg on my face after that one. Okay, it's Glenn in brackets. I think that's it, ladies and gentlemen. I won't keep you any longer than I need to. We've done everything here. XJO for Nick. Let's have a quick look at that one. And then we will adjourn. Okay, so I'm just going to go back here. Let's have a look at the ASX 200 for you. Probably should have done that in my initial wrap up, but it is a good place to finish. We talked about this session is all about understanding global macro and how it impacts your portfolio. And here we are back finishing with the ASX 200, which that short-term trend, you can see I actually do have to do this manually and change the colors, is now a short-term downtrend. Just haven't updated it for a few days, and it has recently changed its trend, so let me change that color for you. Long-term trend is still flat and neutral. And we are really just stuck in the middle here, aren't we? And I think as long as we stay above that low there, 70, 90, I think we're okay. I don't want to see it get beneath that low simply because it will push us further down towards 69.98. And that is your intermediate point of demand. But, you know, more than that, or far more significant than that, are going to be these lower points of demand at 68.95 is the lowest of the three there, being 69.98, 69.05, and 68.95. So that is how that looks. To the upside, where do we need to get some more confidence? I don't think the situation is completely irretrievable, but plenty of work needs to be done. We need to get back above 72.50 really to have any confidence that we can start to challenge what now should be a pretty significant area of supply between, say, 72.85 and 73.62. They are going to be supply zones. It's just so stuck in the middle, isn't it? And that's frustrating. Look, within that, what are the sectors doing? Discretionary doesn't look terrible. I think that's one of the better looking sectors out there. Energy still looks pretty good, pulling back a little bit more recently on the back of those oil prices. Financials looks ho-hum, doesn't it? Sort of just stuck in the middle. A nice comeback over the last 3 days, but ho-hum. Gold got belted. It's trying to rally today. I'm a little bit skeptical about that sector. I'm not sure if I want to rush in and pick up gold companies just yet, but happy to consider it if that improves. Healthcare still looks pretty awful despite Cochlear's bounce. I guess CSL, which is the major weighting in that index, continuing to bring that down. I think Ramsay also had poor earnings today. Technology looks okay, but I think starting to lose the battle a little bit here. I don't want to see it get beneath 1800. Until then, I could be holding on, but below 1800, I think it's starting to roll over. Materials, I think this one's in trouble. I know we've had a little bit of a bounce in those mining majors over the last few days on the iron ore rally, but my fear is after such a long period of time where this long-term trend ribbon has offered dynamic support, it may move into a new phase where it's offering dynamic supply resistance. And certainly beneath 1700, it's going to be lights out for this one. Could fall a long way and it could fall very quickly. Property trusts, neither here nor there, a bit like financials, stuck in the middle. Staples does not look good to me. Not interested in that one. Telcos, that's the Telstra index, pulled back. And I think the fun is over there for Telstra. Utilities index is the AGL index. And I think the fun is also over for AGL. Very choppy, says Max. Absolutely. Okay, let's head back here and wrap up today. Thanks for joining me, of course. Hopefully it was worth your while. Tuesdays, we do ASX. Friday, 1:30 p.m, we do US shares. That's the one you want to tune into tomorrow. As we look at NVIDIA, no doubt, Microsoft, Meta, Tesla, all of those big blue chip US shares. Head to www.thinkmarkets.com/au/webinars to register and participate here with me in the Zoom session. If you're not a client of ThinkMarkets, we should be, because we are the good guys in the Australian broking scene. We have over 3,100 shares, actual shares you can trade, not the CFDs, but the proper shares, $8 flat rate, CHESS and HIN sponsored. You might get a cheaper rate elsewhere, but it won't be CHESS and HIN sponsored. And it really needs to be to ensure that you own your shares. We do offer those CFDs, as we saw on something as wonderful as the US dollar versus the Chinese yuan. Isn't that fantastic? Indices. You can trade the NASDAQ, you trade the Russell 2000 futures like wheat. How good is that? Crypto, Bitcoin, and shares as well, both here in Australia and in the US. Market leading spreads and commission free on shares. Great way to trade. www.thinkmarkets.com/au to open an account, because we are an award-winning broker. We keep winning them, we keep getting nominated. We've got great platforms. And most importantly, we've got great customer service, 24/7 customer support. You can actually call us on the phone and speak to us. If you're watching on any of the streaming services, please hit the subscribe button to stay notified of my video updates. I do go live a few times a week, and hit the thumbs up button to let me know you like what I'm doing, so I'll continue to do more. I really do appreciate your support in that regard. Apart from that, it's been a pleasure chatting with you today. Exciting times, no doubt will be exciting next time we catch up, and all the best until then. Bye-bye for now. Before you run away, just keep in mind that everything we've discussed today is general in nature and has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, you should consider it carefully or seek the help of a financial professional. The rest of the information in that disclaimer is important, and you should read it. And if you have any questions at all, please give us a call or head to the website and download a product disclosure statement or our financial services guide. Bye-bye.